Finances and Company Stock Options with Kathy Pfeffer-Hahn. Finances and, in conjunction with my company, Capital Coaching, helps people achieve their financial goals through personal, tailored, and attentive financial coaching services. Together, we create a successful financial plan by examining your spending and saving habits and then guiding and educating you to your own personal success. Coaching services include evaluation of your spending plan, building your savings, financing your retirement, examining your insurance needs, and planning for your individual goals. Please contact me at capitalcoaching.net to make an appointment for a free consultation. Sometimes companies will offer you a stock in the company that you work for as one of the benefits for working there and as a form of compensation. It makes perfect sense. As part owner of the company, you'll be even more invested in the company's success. It's a great way to motivate current employees to stay and attract prospective new employees. Stock options can be granted to employees, contractors, consultants, and investors and allow them to buy a specific number of shares of the company's stock at a preset price. This price can be called the grant, exercise, or strike price. The employee is given these shares but doesn't take ownership of them until a fixed period of time called the vesting period has passed. Once that date arrives, the employee can purchase them from the company. This wait time or vesting period is what encourages employees to stay at the company until the date of vesting arrives. If you leave before that date, you don't get the stock. So how does it work? A company could grant, say, 10,000 shares with a 4-year vesting schedule, with the ability to exercise 2,500 options each year. So to claim all 10,000 of the options, you'd need to stay for all 4 years. The price of the options are determined by finding the price of the shares, or the strike price, the amount that the company offers them to the employee. Let's say the price of the shares on the open market are $20, and when they finally vest, they have risen to, say, $25. That means that each share is worth $5 to the employee, or $5 times 2,500 of them. That's a $12,500 profit to you. This could be incentive stock options, or ISO, or non-qualified options, NSO. The NSO stocks are taxed as ordinary income. In other words, it's just added to your income on your tax returns. Any money you make is called a capital gain, but if you don't exercise them by a certain date, they're forfeited by the employee. The ISO shares are awarded to only top management of the company and can be for publicly traded companies or private companies planning on going public. They need to be exercised within 10 years of being granted with a standard 3-year cliff schedule or a graded vesting schedule, with 1/5 of them being granted each year for a total of 6 years. Finally, these shares can be clawed back or returned to the employer if the employee leaves other than a death, disability, or retirement, or if the company just can't financially honor the options. Once you're ready to exercise your options that you've been granted, you'll have a few ways to do this. The first is using a cash payment. You come up with cash to exercise the options at the strike price, the price they were when you were given them. Or you could use a cashless exercise by selling just enough of them to cover the cost of exercising the other shares. Again, exercising is the buying and selling of them. Or you could do a cashless exercise, and this means that the employer allows you to sell them immediately at the current market price. Some options do have an expiration date, often 10 years, but you'll have to check with your contract to see if that's true. The bad news is that if the stock loses its value, you lose the income as well, and that's riskier than getting paid in cash. Sometimes an employee buys company stock as well and ends up having a large portion in their portfolio of their employer's stock. This is what happened to Enron employees when their 401k plan had almost as much as 60% of the company's stock in it. And then when it failed, the employees lost their 401k when they lost their jobs. And this $90 share stock that they had dropped to 50 cents a share. Employers like giving options because employees gain as the company performs well, because the shares increase in value and then they both win, incentivizing employees to be productive and boosting company earnings at the same time. It also keeps employees working for the company and not moving on so that they can collect their options. There are other advantages, too. There's no cost to the employer to issue options, allowing cash that's not given out to employees to, say, in bonuses, be invested in the company. There are other types of employee equity compensation that are similar to stock options. One of these is the restricted stock option unit grants. They include a vesting period with a requirement of how long the employee works at the company before they can access a certain number of the options. Once those requirements are met, the employee can exercise their options. These shares are almost always worth something, even if the price drops dramatically. Shares are received by the employee after the investing date, and the company can pay out dividends along the way. And unlike other dividends, they'll be reported to you on your W-2 as income. The benefit is that no matter what the stock price is, whether it drops or not, you can still sell them and receive the selling price, not the delta between the exercise and grant price, as mentioned before. The second type is the employee stock purchase plan. This could be made available to all employees or just certain levels by job title. This can include a discount to employees based on the value of the stock at the time of purchase, allowing it to be purchased up to a maximum discount of 15% from the current market value. If an employee owns more than 5% of the company, they cannot participate in the employee stock purchase plan. Employees will have a stated amount deducted from their paycheck and contributed to the plan. The IRS says that these contributions must be capped at $25,000 a year, though. The third option is called phantom stock. This is where the employee receives a bonus for a certain amount of shares and the projected value at a certain time. In this case, there's no ownership, transferring, or exercising of shares. Sometimes phantom stocks can be converted into real shares instead of cash bonus. There are two plans, appreciation only or full value. Appreciation only does not include the actual stock value, but the amount that the price rose over a period of time, starting on the day that it was granted to the employee. Full value pays the actual stock price and the increase or appreciated value. This can be used as a benefit for upper management and is tied directly to the company's performance, but it can be presented to any level employee. These options are not as straightforward as a paycheck, but they can offer a large payout and be a great option for you. Read carefully the contract you're presented and consider having a financial planner review it and explain how it will affect you and your taxes before you sign. This is Kathy Pfeffer-Hahn. Thanks for listening to Finances and Company Stock Options. I know you chose to listen and I'm grateful. If you enjoyed this episode, please follow or subscribe for free in your podcast provider and share your favorite episode with a friend. I'd love you to leave a review because it brings financial education to others and helps people find me more easily. Also, let me know what questions you'd like answered or any topics you'd like covered by going to the website at financesand.net and leaving a message. You can also contact Capital Coaching for your personal financial needs at capitalcoaching.net. Finances and does not provide tax or legal advice, and nothing in this podcast is to be construed as such. Always consult a tax, accounting, or legal professional for advice on your specific situation. Remember, I went to school, so you